Welcome to Stock Talk with Mike. I've spent a lot of this weekend looking through my holdings, looking for companies that I might add to with this pullback we're seeing, especially if we see any more selling pressure this upcoming week. And one of those stocks that I own that's actually sold off pretty heavily is Teladoc Health, and it's actually one of my highest conviction stocks. So I just want to go through the Q4 report that they reported on February 24th. And I think actually it might be a bit of a buying opportunity here. We've seen about a 28% sell-off off the all-time highs a couple weeks ago, down from all-time high of 308 down to about 221 as the time I was recording this over the weekend. So stay tuned. If you like this kind of content, please consider subscribing to the channel. It'd be great also if you like this video. Teladoc Health, ticker TDOC, is the biggest virtual healthcare provider by far, and they're growing like crazy. I've done a number of videos on Teladoc, and if you haven't, you might want to check out those videos that dive a little deeper into what the business does. But I want to focus on their recent quarterly report and run some numbers and where I think they might go in the future, and update my price target predictions for Teladoc as well. So they just reported quarterly earnings on February 24th. And the results are actually really good, especially from a revenue standpoint. I mean, you know it's a really good quarter when the analysts at the Q&A at the end of the conference call are congratulating the company before they ask their questions. And that was happening over and over again at the end of the Teladoc call. So I thought that was a pretty good sign. So just reading the headline here from their press release. So Q4 revenues grow 145% year over year to 383 million. Total visits increase 139% to 3 million. Full year revenue grow 98% year over year to just almost 1.1 billion, and total visits increase 156% to 10.6 million. So just massive revenue growth. Clearly they're a beneficiary of COVID, but that's still actually a relatively small percentage of the visits they see. They're a whole holistic virtual healthcare provider, everything from mental health to regular doctor checkups. So I think definitely COVID has sped up the transition to virtual care, but I think that's only a trend that's going to continue to grow. So just going on, some comments here from the CEO, Jason Gorovic. So as virtual care shifted to become a consumer expectation in 2020 due to COVID, Teladoc Health not only met the rapid growing demand, but we transformed our company to define a new category of whole person virtual care. By accelerating our mission to transform the healthcare experience, we exceeded our fourth quarter and full year 2020 expectations and see strong momentum across our global business in 2021 as the market embraces the breadth and depth of our unique capabilities. So that kind of speaks to the fact that they're more than just a COVID-19 play. They did report a massive loss on the quarter. So it was a $394 million loss in the fourth quarter of 2020 compared to just $19 million loss for the fourth quarter of 2019. So on the surface, that number could look pretty alarming. But honestly, even a lot of the analysts in the conference call Q&A weren't really concerned about this, because the fourth quarter and full year 2020 includes 57.6 million and 88.2 million respectively of acquisition and integration related costs, as well as 331.7 million of accelerated stock-based awards expense related to the merger with Livongo. So a lot of these expenses that they saw in the quarter are still related to that massive acquisition. That was almost more like a merger, because Livongo was almost as big as Teladoc. So it was a massive transaction, and that's still showing up on the balance sheet. So I don't think it's a big concern there. One thing I really like about Teladoc, they seem to have a real grasp of their business and future revenues. They provide really good guidance, clear guidance, quarterly as well as annual. So I really like that, just being able to get some insight into what the future is going to hold for a company. And why not? Like, Teladoc's absolutely killing it, so they got absolutely nothing to hide. So this is the guidance they provided for the first quarter of 2021. Total revenue to be in the range of 445 million to 455 million. So in Q1 of 2020, revenues were 180 million. So that would be 153% year over year revenue growth upside if they hit those numbers. Adjusted EBITDA, so earnings before interest, tax, depreciation, and amortization, 45 million to 48 million. So in Q1 of 2020, that was 10 million. So that's a massive EBITDA improvement as they decrease their earnings losses and move towards profitability. And then for the full year 2021, they provided total revenue guidance of $1.95 billion to $2 billion. So the full year 2020 was just $1.09 billion. So that's almost doubling their revenue again in 2021. So that's really impressive numbers after some pretty big comps they saw here in just past in 2020, where they already saw explosive revenue growth of well over 100%. And adjusted EBITDA to be in the range of 255 million to 275 million. That was just 126.8 million in 2020. So that's 117% increase in adjusted EBITDA. So again, really impressive. Another thing I did this weekend is I was digging around a bunch of 13F filings, just seeing where big money managers and institutions were putting their money in Q4. So October, November, and December. And in Teladoc, I really like what I saw. So there was 616 money managers that either took new positions or increased their position in Teladoc, where only 229 either closed or reduced their position. And institutional ownership is now almost 80%, whereas previous quarter, it was only 52%. So definitely was being bought up by institutions in a big way. Looking at the 6-month chart of Teladoc, you can see it was trading sideways for the last part of the year through Q4, and then shot up aggressively up around 20 or 30% or so in the new year, and then reported earnings right during the big tech growth stock sell-off that we recently saw, and shot down about 28% or so off the all-time highs of $308 a share. And if you look here, October through December, when those Q4 13F filings were happening, when those institutions were buying up, Teladoc was trading between about $185 and $225 a share. So we've actually gotten right back into that range where money managers were aggressively buying Teladoc. So it makes it kind of an interesting stock here. And taking another step back, this is looking at the 5-year chart. I've actually been in Teladoc since February of 2018, and it's been on a great run. And you can see how big this sell-off and how quickly it happened recently and dropped down to previous levels there. So it definitely looks like an outsized retracement of the share price. Back in January, I did a 5-year out price target for Teladoc, and I used a compound annual growth rate of 50%, 50, which might have seemed pretty aggressive, but it was based on some modeling that Kathy Wood and ARK Invest had done. And then honestly, Teladoc themselves just gave guidance for the full year of 2021 with revenue growth north of 80%. So you could definitely see how they could get to that kind of growth rate, continue moving forward. But based on the numbers and the share price at the time and that growth rate, it basically worked out to an average annual return of still over 30% annually over the next 5 years. But I've rerun the numbers now with the new share price and then using the guidance they provided in 2021 and to have a look at where that might be for share price in 4 years from now by the end of 2025. I've updated the share price to $221 a share, which it was on Sunday night when I filmed this. And I updated the revenue for 2021 based on their guidance of $2 billion. And then looking 4 more years out, so by the end of 2025, for expenses, I've kept cost of sales pretty much the same and advertising and marketing pretty similar. Same with sales, technology, and development. Where I've reduced their costs is on acquisitions, as I assume these big acquisitions will be, there'll be less of them moving forward, especially in 5 years from now. And then administration as well, that it still goes up, but it would kind of fall in line with sort of industry standard of around 10% and other expenses around 5%. And working with a net profit margin of 40%. And so here I've used a growth rate of just 40%. So I've made this a lot more conservative based on my rationale there is that they had over 80% here as far as guidance for 2021, that they might have leaped ahead and already kind of baked in some of that future revenue. So I've reduced it from 50 in my old model to 40 here. And then I'm using a forward PE, sorry, not a forward, a price to earnings ratio trailing of 40. And that would give us still, even at only a 40% growth rate over the next 4 years, and with a PE of 40, that would put us at a share price at $848 a share by the end of 2025 or beginning of 2026, which would be a 284% total return and an average annual return of 40% from here. And even if we reduce the PE, so this is a company growing at 40%, so a trailing PE of 40 would be quite good, really, it'd be fine. But if we lowered that to 30, let's go very conservative here. We're already conservative on the growth rate. That would still be a share price of 636 and a 30% annual return, total return of $187 a share. So I really like what I'm seeing here with this current share price, and based on the revenue growth we're seeing, I think Teladoc is actually really well positioned right here. So I actually really want to add some more Teladoc here, even though it's still probably I think the fourth largest holding in my portfolio overall, but it's just sold off a lot more than most of my other holdings during this tech kind of growth stock sell-off that we've seen as of late. And I think they're just still really well positioned for outsized returns and growth moving forward. So as I mentioned earlier, I actually originally bought Teladoc 3 years ago at around $34.50 a share. It was actually back in February of 2018. So I'd be massively increasing my cost basis. But honestly, I don't give a crap about that. I think people get way too caught up in cost basis. It actually really doesn't mean anything. I mean, every stock is traded cheaper before you bought it. It really has nothing to do with your future performance. It's the same when people talk about, oh, I wouldn't buy it here, but if I owned it, I wouldn't sell. Well, a stock, if you go to bed owning a stock, that's the same thing as buying it in my perspective. So again, cost basis has nothing to do with future performance. I think people get way too caught up in that. Like sometimes the fundamentals of a company change, and even though it may be way more expensive now as far as its market cap and share price, that company could actually be a better deal because some of the underlying fundamentals of a company have changed. Maybe they've made a massive, really strategic acquisition or moved into a new industry with a bigger addressable market, right? There's lots of things that can happen that actually make a company more attractive as it becomes more expensive or trades at a higher price. So keep that in mind. But I might get a little bit greedy and wait and see if we have a little bit more of a sell-off next week or this week, and see if I can get it at a little bit lower price. But part of me would just like to buy it right here. So I haven't quite made up my mind. I should just pick a line in the sand and set a good to canceled order in at a certain price and see if it hits. But I think it's actually quite attractive here right at these levels. But that's about all I have for you today. So thank you for watching, and happy investing.